could. We've had ourselves to blame for our love. Oh, I tried to hold you close, but you just left me. I need to find a way out from this hell by myself. I keep calling, but you won't seem to listen. I keep walking, but I can see you following. Oh, 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 oh. Oh, 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 oh. Hey, yeah. Oh, I will leave and not come back anymore. Oh, 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 oh. You will feel the way you've been treating me. I keep calling, but you won't seem to listen. I keep calling, but you won't seem to listen. I keep walking, but I can see you following. I keep calling, but you won't seem to listen. I keep walking, but I can see you following.
Welcome to another session of training, and as you perhaps saw from the last screen, it's going to be when to use hourly billing, when to use fixed prices, when to use value pricing. But before we start, we've got a couple of minutes left, perhaps a bit less than that. Let me just give a few shout outs, see who we've got here. So first to arrive as usual is Robin from Moscow in the deep freeze. So welcome to you, Robin. Welcome Tammy from Canada. David Bennett's here from Murfreesboro. Okay, who else? He says, you work to break me from the bad habit of hourly pricing. Are you taking me back today? No. Lisa DeHaas is here. Hi, Lisa. Michael's here as well from Texas. We have Martina from Ireland. Hi, Martina. We have Alan Brown from Margate in the UK. Doreen from Oklahoma. We have hello all from, Anna from North Carolina. Hi, Anna. Isabel's here. So here's Joe. I see there are also a few people who are logged in both in some other places, Facebook. So I don't know who it is because I think there's a link in the Facebook post to give permission for me to see who you are. But someone did say, you're rocking out some music and have a new profile pic with a guitar. Has your friend Neil been influencing you? So I have no idea who you are. But if you click on the link somewhere, it should give permission. That'll be cool. I also have here from New York, she's on Facebook Live, is Jennifer. Hi Jennifer, good to see you from New York. Let's just see very quickly, because I need to start, it's on the hour. There are so many more comments in the chat box in here. Let me see if there's any other countries I've not mentioned yet. So far, everyone's from the UK, Canada, or the US. Where's my friends from South Africa? I forgive you if you're in Australia, because I know it's a bit late in Australia. Bermuda, okay, Megan's here from Bermuda, hi there. And Leslie's here from South Africa, awesome. Oh, and Lars is here from Sweden. Hi there, Lars, good to see you. I think so, we've got a fair range of countries. Okay, it's on the hour, let's get started. So welcome to this session. If you've never been to these sessions before, this is how it works. And I know that for some of you, you may well be on Facebook right now, because we're going live to Facebook and also my YouTube channel, because we get people in Australia sometimes say, Mark, is there a recording? And there never has been on these monthly sessions for the last 3 years until last month, and we've changed it now. We are going to be running them, at least for the next few months, we'll be running them on some social media channels, and then we'll turn them back off at some point. But that just gives people to catch up. It gives people an opportunity if you're in Australia. But most people are here in Zoom, which is the best place to be at the moment, because we're going to run a poll in a short while. So this is how it works. If you've got questions for me, what we're going to do is I've got 30 minutes of content, then a few announcements, and then we usually have 20 minutes of questions, perhaps 25. I'll answer as many questions as I can in the time we've got. We finish on the hour with 60 minutes these sessions, and we will keep to the 60 minutes. I'll answer as many questions as I can. If you're on Zoom, stick your questions in the Q&A panel, not the chat box, because that goes crazy and I will miss them. I have Sarah monitoring the chat box, but if you've got questions for me and you're on Zoom, stick them in the Q&A. If you're in Facebook or YouTube, stick them in the comments if you've got questions. If you're on Facebook, I'd appreciate it if you just click on the link to give permission to, because you have to give permission in Facebook to let me know who you are. Otherwise, I won't have a clue who you are. So ask your questions there as well. I'll look for those questions later. So questions in about 40 minutes from now. Questions about anything, the content from today, anything else. So that's that. What else do I need to tell you? Anything else? We need to run the poll. So what we do is, if you're new, we kickstart these sessions with a poll, which does actually mean that if you're on Facebook, you won't be able to participate in the poll because it's a Zoom thing. But we are going to figure out another way in future months how we can run the poll outside of Zoom. So if you're on Facebook Live or YouTube, then we'll keep the poll short. This is just a chance for people to vote for what they want to cover next month. So today's session got the most votes last month. You get to choose what I teach you each month. So for those, you can type in Facebook if you want. If you've got a choice, you can type in. It may influence. It could be the casting vote. It could be the decider. So let me know. Here we go. This is what we might cover next month. Let me know your votes. Do you want to look at what does your ideal customer really want? That should be ideal rather than idea. How to get great prices for payroll. What should I measure if I don't keep timesheets? 5 ways to use Facebook to win more clients. So there's a marketing one there. And how to increase profits and cash with recurring revenue. Okay, so which of those will be most useful to you? If you're on social, you can still type in how do you find out what your ideal customer wants? Pricing payroll, what to measure without timesheets, 5 ways to use Facebook to win more clients, or how to increase the profits and cash with recurring revenue. And it's really, really close this month. I'm just watching. You can't see it, but it's almost neck and neck, 5 ways split. So I'm going to keep it going for a little bit longer until we have a clear leader, because we've got the two top ones are within a vote of each other. Okay, so if you are on Facebook, if you want to cast a vote in there in the comments, it may influence the decision. Sarah, I think we're getting close now. I think we're getting close. So I'm going to give it 3 more seconds. Going, gone. Let's close that. Let's hope it's not a tie. So it's not. Let me just share the results. And I know that if you're on Facebook, you can't see this, but everyone else can. So just by a handful of votes, and also somebody in Facebook said the same thing. You want a marketing topic next month? That's fine. We can do marketing. That's fine. We'll look at 5 ways to use Facebook to win more clients. That narrowly beat the second choice, which was how to increase profits and cash with recurring revenue. So that one, what happens is that one goes into the pot for next month, and we'll also pick 4 new topics next month. So the one that comes second, we get a second chance next month, and the other 3, they'll come round at some point in the future. So clearly they're all popular ones anyway, so we will get to cover them all at some point. Okay, so someone says and again, I don't know who you are, they say in the Facebook group, how to watch in Zoom. How to watch in Zoom, I don't know. There's a link, and I think my team might put the link in there if you want to switch across. I will leave that to them to sort that out. Okay, so that's the admin out of the way. We could dive into this month's content. So if you're ready, I'm just going to move the chat box out of the way for the minute because that will just distract me. Don't need that. So let's dive into today's content. So, question I get frequently is, so Mark, when should I use hourly rates as opposed to, and when should I use fixed fees? When should I use value pricing? And it's actually a very strange question that when people ask me that question, because it's actually a nonsensical question. It doesn't actually make any sense whatsoever. And the reason for that, and I think the reason why the profession generally finds pricing challenging is simply because there's so many misunderstandings and so many about pricing. And very often it's the terminology that people use. Different people use different phrases and terminology in different parts of the world, which gets confusing as well.
Mark, excuse me, can I just interrupt you?
Please do, yes.
The volume has just dipped a little bit.
My volume's just dipped a little bit. Okay, let me just check that. It looks fine at my end, Sarah, so I'm wondering if that's a Zoom issue. If there are problems with Zoom. Zoom is it's been very, what's the word I'm looking for? We've been having a whole host of Zoom problems for 6 months now, and it's because everybody's using Zoom. We are looking to do other things. So I'm hoping it's all okay on Facebook. If it's okay on other social channels, if you're there, you might find that's the best place. If you're having real problems in Zoom, you can move across to one of the other places. I'll leave Sarah to sort that one out. And I will just check. Someone said, volume's fine on Facebook. It's a Zoom problem. We're having so many problems with Zoom. I'll tell you more about that later, but I'm going to leave it with Sarah. She will type into the chat box if you want to shift to another platform. Okay, with that said, let me get back into the presentation. So where was I? So there's a lot of confusion around pricing. And so this question of when should I use hourly rates, when shall I use fixed fees, when shall I use value pricing? It's nonsensical because we're not comparing the same things. Let me explain what I mean. One of the nice things about pricing is there's really only two ways to price, okay? There's just two options if we really simplify it. And that is, we can price our services using what's called cost plus pricing or value pricing. And that's it. That's it. It's cost plus or value pricing. Now, there are lots of different pricing models, methodologies, ways of pricing. But every different pricing model, and I'm going to go through quite a few during this session, every pricing model is either a form of cost plus pricing or value pricing or hybrid somewhere in the middle. So let's get that on the table straight away because that's going to make things easier. There are only really two ways to price. Cost plus, value pricing. Okay? Now, fixed pricing is really a characteristic of many different pricing models. And so I'm going to come on to fixed fees in a short while and explain that a little bit more. But it's largely more, it's a pricing model. It's sometimes a characteristic of pricing models. And hourly billing is a pricing model. Okay, so we have lots of pricing models, but they all fall into one of two camps. Cost plus, value pricing. So let's start with a definition first, and then what we'll do is we will explore hourly a bit more, fixed fees, value pricing a bit more. I'll look at each of those three, but let's just be clear that there is cost plus pricing and value pricing. Cost plus means that and if you've ever studied economics, may have heard of the law of supply and demand. There's a demand curve, there's a supply curve. And really cost plus focuses on the supply side of the equation. In other words, cost plus means that we arrive at our price by looking at our costs, adding up the costs for delivering a product or a service, adding on to that cost an amount for our hoped for profit, a margin if you like, and magically there's our price. We start with costs, add on our profit margin, and there's our price. That's cost plus pricing. The problem with cost plus pricing, well, there's many problems we'll come on to, but one of the problems of that is that it ignores the customers. It ignores what they want. It ignores the demand side of the equation. So what value pricing does is it starts at the other end. Value pricing starts with the customer first. What does the customer want? What does the customer value? And value pricing means that we come up with our price based upon what the customer values and nothing to do with costs. And a lot of accountants and bookkeepers struggle with that because we are so focused on costs. We feel that we have to cover our costs, and we struggle with value pricing because costs are irrelevant. They are irrelevant. What matters is that we deliver value to our customers and we price based on that value. It's a fairer way of pricing, as we'll look at later. So hopefully those two definitions help. Cost plus pricing, we add up our costs, add on a profit margin, that's the price we come up with. It ignores the customer. Value pricing starts the other end. It looks at the demand side. What do customers value? And we price based upon value. So with that said, I'm going to now look at each of hourly rates, fixed fees, and value pricing. So let's start with hourly rates. When should you use hourly rates? I would argue never use hourly rates. Now I'm going to give you an exception in a short while. There's always rules are there to be broken, but generally speaking, you shouldn't. Hourly rates is a pricing model. It's a pricing model that is 100% a form of cost plus pricing. It's cost plus. And over 100 years ago, it was demonstrated by the Austrian School of Economists that cost plus pricing is a crazy way to price for so many reasons. And time-based billing or hourly billing in particular is a terrible way of pricing. Why is it a form of cost plus pricing? Well, if we think about where do hourly rates come from? How do we come up with a price with hourly rates? What we do is we take an hourly rate, we multiply it by hours, time spent, and magically there's our price. It's cost plus because how have we arrived at an hourly rate? Where does that hourly rate come from? Typically in the accounting profession, it's a multiple of costs. Typically, and I've done benchmarking studies in the UK, amongst accounting firms, hourly rates are usually arrived at by multiplying chargeable salary costs by somewhere between 3 and 3.5, sometimes a bit more. Let's go with 3 just to keep it simple. 3 times chargeable salary costs. Why 3? And this is where this crazy third model came from. What it means that if we pay somebody $50 an hour, we charge them out at $150. And the thinking is that we hope that that $150 will cover their salary costs of $50, our best estimate of the fixed costs, $50, and then the other $50 is our profit. It's a form of cost plus because all we're doing is looking at the hourly rates arrived at by looking at the direct cost, i.e. the salary cost, plus something added on to cover fixed costs, plus our hoped for profit element. Okay, it's cost plus pricing. So we know from what the Austrian School of Economists taught us over 100 years ago is that cost plus is crazy. But hourly rates is crazy for a whole host of other reasons. So let me give you just a handful of problems with hourly rates. Firstly, customers hate it. Customers hate it. Back in November 2005, I know it's a while ago, but back in November 2005, Sage, the software company, did a survey in the UK of thousands of business owners. And they asked an interesting question. They said, what's the thing you hate the most about your accountant? Pretty strong language. The answer was, the number one response overwhelmingly was surprise bills. Customers hate surprise bills, and it's no surprise because we hate it. It's the one thing I hate about hiring a lawyer. I say to the lawyer, I need to do this contract for me. What will it cost? Our rates are $200 an hour. Okay, well, I've got another question. You know what the question is going to be. I'm going to say, okay, so how many hours will it take? And they say, I don't know. We haven't done the work yet. But they then say, but trust us, we're professionals. We keep accurate time records. We log everything. And at the end of the work, we'll send you an itemized bill that breaks down the hours we've spent, what we've done, multiply it by 200, and there's your price. I hate that when dealing with lawyers. We all hate it as customers. Your clients hate it. So why do we inflict it on them? And you shouldn't need any more reasons. If customers hate hourly billing, sometimes it's called surprise billing. Sometimes it's been referred to as ambush billing because people don't know the price up front. It's always a surprise. Whatever that bill ends up being, it's going to be a surprise. So if for no other reason, we should stop doing it for that reason. Stop doing hourly because customers hate it. But also there's many, many other problems. I would argue it's not a fair way of pricing. In fact, I would go as far as saying it's potentially unethical and potentially bordering on negligence. And why do I say that? And the reason I say that is because our goals are misaligned. If you want to get a higher price and you're billing based on the hour, how can you get higher prices? It's really simple. You just work slower. And yet that's not in the interest of the client. That's the absolute opposite to the client. They want you to work quicker. They want you to get things done fast. So we've got misaligned goals with hourly pricing. Not only that is, because we price based on the hour, customers hate it. There's a problem with psychology with hourly rates. We must stop quoting hourly rates because there's no inherent value in an hourly rate. Nobody comes to you to buy an hour of your time. Nobody's interested in buying hours from you. They want to buy your knowledge, solutions, results. They're buying value. So why do we price based on an hour of our time? They don't see a value in that. But even worse than that is you will often find when you give an hourly rate, you will get the reaction, that's expensive. Why? Because what we learn from something called price psychology and a branch of science called psychophysics is that we are clueless about price. And so what happens is when somebody gives a price or an hourly rate, our brains go off subconsciously to make a comparison, to compare with something else. So if your hourly rate is, let's say you're a bookkeeper and you charge $70 an hour, which is crazy cheap, but anyway, if you charge $70 an hour, when you quote that, what happens is the client's brain goes away to compare that with something else, to get a handle on whether that's a fair price, a low price, a great deal, a high price, and it all happens subconsciously. They don't know they're doing this, it happens so fast, but usually it may be something like they've just paid their cleaner that morning to clean the office or to clean their home, and they pay the cleaner $20 an hour. And that $20 they've just paid is in their mind. When you say 70, they make a comparison. Their brain comes back with a feeling, with an emotion. Price is an emotion, it's a feeling. And so what will come back is the brain will say something like, wow, that's expensive. So you'll always struggle when you give hourly rates. And you know that because you've tried that. And the problem then that we have, and this is now getting back to the negligence, unethical issue, is because we use hourly rates and because we get pushback from clients and because we hate that no answer, we hate rejection, we hate it when someone says that's expensive. And so what we do is to try and avoid that, we try to be efficient in the work that we do. So let me give you a story. When I was a manager in an accounting firm, so this was before I started my accounting firm in 96, so 94, 95, I was a manager in an accounting firm. And so I would be working on various jobs in the firm, and in those days they kept timesheets, there was hourly rates, and so time went onto the timesheet. And towards the end of the job, I would then, as I'm doing the final review, I would request a work in progress report. And I would have a look at that report. And almost every single time when I ran out the work in progress report, it was a case of, wow, that's more than I'm expecting. I'm not sure we can bill that. I think the client's going to complain. Usually we find that the work in progress is higher than we expected. And so what we do is we then start to think, well, I want my numbers to look good. I want my recovery rates to look good. I want my billing targets to look good. So I need to be efficient here. I need to get this job finished off as quick as possible. I need to get these review points sorted out with the senior. I need to get the client in fast, have a quick meeting so I can get it out quickly and move on to the next one. And that is in exactly the wrong thing for the client. It's the wrong thing for the client. Why? Because when we're thinking about how we add value to clients and how we change people's lives, yes, there's some value in the compliance work that we do, but the real value of what we do in our profession is we can change lives. We can save businesses, quite literally save businesses. We can help people get more funding, and we can give them advice, advisory work and so on. But if we're up against the budget and the clock, and therefore rushing things to finish off the job and the compliance work, we're missing opportunities to help the client because our focus is on time. Now, if we switch to value pricing, and I'm jumping ahead a step now, but if we switch to value pricing, it's a fairer way of pricing because we're on the same side of the table. In other words, what does the client want? They want more value. They want you to save them more tax, to help them increase their profits more. They want you to save their business, to help them achieve their goals. They want you to deliver more value. When you price based on value, it's in your interest too because you make more money when you add more value. You're both on the same side of the table. And so now You are incentivized when you finish doing the compliance work to invest time thinking about how you can make the client's life better, to go above and beyond what they might have asked you for, to start thinking about some tax planning, some advisory, some ideas on how you can help their business. And when you do that and come up with ideas, you add more value, the client's happier, and when you use value pricing, you can charge higher prices. So I've given you a whole bunch of problems with hourly rates. Let me give you one more and then we'll move on quickly. A big problem with hourly rates is you don't know what the price is either until you've added up the hours. So not only does the customer hate it because it's a surprise bill, but from your point of view, because you don't know what the price is going to be, you can't get paid until you've finished the work, added up the hours, sent out the itemized bill, sent it to the client, and then you keep your fingers crossed and hope the client pays you in your payment terms. And that's a crazy way of getting paid. We're in the service industry. We should be paid in advance. And most of the firms that I work with now in the Value Pricing Academy are doing exactly that. They're getting paid in advance. No more debtors or accounts receivable on the balance sheet. You shouldn't be owed money by your clients. And if you give a fixed price up front, you can solve that. You can get money up front. But you can't with hourly billing because nobody knows the price until the end of the process. So you should never use hourly rates. There's hourly rates, hourly billing for a whole bunch of reasons. I've given you some of them. There are many more as well. Now, what's the exception to that? The only exceptions I can think of is two situations. Number one, if it's some form of legal requirement. And I'm not aware of any legal requirements. I know that lawyers sometimes say that court work has to be done like that, and that may well be right. I'm not an expert in law. And sometimes if you're using professional fee protection insurance, I believe that the insurance companies will ask you to keep a record of hours in that situation. But it's extremely rare. Unless there is a legal reason or some contractual reason to price based on the hour, you never should. The only other exception number 2, is if the client wants it. And I've been told sometimes clients say they prefer to just pay by the hour. And okay, if that's the case, then if that's what the client wants, they get that. But if they want an hourly rate, I would at least give them the choice and explain to them the benefits of giving them a value-based fixed price up front. And what I'd also do is, even on hourly rates, I would ask for a deposit up front to cover, so you've got money up front. Okay, let's move on. So that's hourly rates. Let's move on to this idea of fixed fees. So fixed fees is an interesting one because there's a lot of misconceptions around fixed fees. I've heard a lot of people saying, great news, I've moved to value pricing, I'm now giving fixed fees. Well, the first misconception is just because you're giving a fixed price does not mean you are value pricing. And the way that most people in the profession, and I think in America they tend to call it flat fees, a fixed price or a flat fee, giving a single fixed price, a single flat fee, is not value pricing, not the way that we do it in the profession. Fixed fees is another form of cost plus pricing. Remember, everything comes back to one of two things. It's either cost plus or it's value pricing, or a hybrid of the two. Hourly rates is clearly cost plus pricing. Fixed pricing, it depends. Fixed pricing is more characteristic of different pricing models. I'll share some pricing models in a bit, that'll make more sense. But the way that the profession does it generally is this. Let's say a client's coming in to have a tax return done. They ask what it's going to cost to do a tax return, and you say $500. Okay, that's a better way of pricing than saying $100 an hour, because of the reasons I've said, surprise bills and so on. Giving the client $500 up front is a better way of pricing because it's fairer. The client's got certainty over the price. There's no ambush billing, no surprises. It also means you can get paid up front. However, I would argue that the way that most of the profession is moving to fixed pricing, it's still cost plus. What I mean by that is if I said to you, where's that $500 come from? How have you arrived at $500? The answer I normally get is, well, Mark, based on all my experience over the years of doing tax returns, I know that a tax return of this type will take typically 5 hours. And my rate used to be $100 an hour, so that's $500. It's still a form of time-based billing. It's still cost plus because the only thing that's changed is rather than waiting until we've added up the hours, we're now giving a price based on our estimate, our best guess of hours. So let's be really clear, fixed pricing, the way that most people do it in the profession, is not value pricing, it's cost plus pricing. However, I would still say it's a fairer way of pricing. At least the customer gets certainty. That's one big benefit. And secondly, you can then get paid up front because you've given a fixed price. So it's better from your point of view. Also, when you give a fixed price up front, it's easy to have a pricing conversation and create some certainty, because one of the problems I had in my firm way back in '96, because I started with time-based billing, the one thing I liked about time-based billing is that I could avoid the price conversation at the start. And that's a terrible thing to do, I learned, because just because the client doesn't ask for the price, you just do the work, doesn't mean they're not interested. And the number of times I got to the end of the work, sent the itemized bill, and then had a fee dispute was countless. So many times I had fee disputes. At least with a fixed price up front, you're forced to have that pricing conversation. And if the price is too high, you just don't do the work. Whereas hourly rates, you can do the work and then find you're not paid. So fixed pricing is way better than hourly. But please remember, it's not value pricing. Okay? So that's fixed pricing. Let me talk about value pricing a little bit. So value pricing, I gave a different definition. Value pricing is we price based on the value. And it's fairer on the customer. It means that our interests are aligned. We're on the same side of the table. Of course, the difficulty is that value itself is subjective. You can't touch it, you can't feel it, you can't measure it. It's subjective. Everybody values things differently. And in our industry, we have a challenge because we have quite complex scope. And so people struggle with value pricing, and I understand that. Value pricing is not easy. It's challenging. It's difficult. However, firms that have made that transition to value pricing are reporting that they are getting significantly better prices, sometimes doubling their prices. I've seen people increase their prices by 10-fold with value pricing. It's a much better way of pricing, because if we think about it, think of it this way. And I'll give you let's imagine that you have you've been on a course, you've done some training, you did a course, and there's a brand new form of tax planning, or new relief around COVID or something you just discovered. And you now know that you could help the client get that relief or do that tax planning, and it's going to take you a couple of hours to do the work. If you've got two clients, client A and client B, client A, you can get them tax savings or relief of, let's say, $10,000. Client B is a bigger business. And even though it's the same amount of work, you could actually get them $100,000, 10 times as much. With value pricing, you would charge client B much more money because there's more value. It's irrelevant that it only takes you 2 hours to do the work. Nobody's buying hours from you. The time is irrelevant. And when you understand that, sometimes people say, Mark, is that not unfair to the customer? I would say it's absolutely fair, because what it does, it makes you more focused on customers and value. When you know that you will get super premium prices, make more money by delivering more value, you will spend more time thinking about how you can change people's lives. If you know that there's an opportunity to do some tax planning or get some COVID relief or something for your clients, and it's more profitable, then you're going to perhaps put aside some of that compliance work and go through your client base and start thinking, how can I really help Mary with this? Could I apply this to James? Could John benefit from this? And we start thinking about our clients, investing time in our clients, not chargeable time, but time investing in them to come up with ways that we can change their life. Because we know that when we can change their life, we can charge much higher prices. Okay, that's value pricing. Now, the challenge, of course, is that it's not always easy to measure value. It might be with tax planning. If we can save someone $100,000 in tax, there's some sort of measure of value. But how do you put a value on things like doing a payroll, of doing a tax return, of doing bookkeeping? And that's where people struggle. And so what we have to recognize is that, as my friend Ron Baker once said, value is in the hearts and minds of customers. Every customer values things differently. They are the ultimate arbiter of value. They will judge what that value is, and we will never know what that is. So we have to use techniques so that we can uncover what people value. For example, we give people choices and options. You've heard I talk a lot about menu pricing, the bronze, silver, gold. When you give people a choice of 3 different tax return services, 3 different payrolls, 3 different bookkeeping services, then each individual customer will choose the one that they want based on their own unique perception of the value of what you can do. So by giving people choices, they will tell you what they value. Now I mentioned, I'm going to wrap up finally with just a few thoughts about this whole idea of pricing models. So remember, there are 2 ways to price: value pricing, cost plus pricing. Hourly rates, hourly billing is a form of cost plus pricing. Fixed pricing really depends on how you do it, but most of us in the profession, it's just based on a best guess of hours, and therefore fixed pricing, flat fees is another form of cost plus pricing. Let's look at some other forms of pricing. So I call menu pricing the process of giving a bronze, silver, gold. That's now starting to move into value pricing. Now, whether it's value pricing or cost plus, partly depends on how do you come up with a price for each of your packages. But it's starting to move to value pricing because what's happening is we're now giving the client a choice, and the client gets to choose based on their perception of value. So menu pricing I often describe as the first step towards value pricing. We're giving people choices. Let me share some other models with you just to give you some illustrations. So percentage pricing is an interesting one. That's a form of value pricing. What percentage pricing means is that we give the client the price is a percentage of whatever the outcome is. Now, interestingly, that means that sometimes people think that value pricing is fixed pricing because you give a fixed price. Percentage pricing is value pricing, but they don't get a fixed price because the price depends on the outcome. So, for example, if you're selling your house, realtors or estate agents in the UK, very often their fees will be a percentage of the sale proceeds. You don't know what the fee will be till they've sold your house. But it's a form of, but percentage pricing is a form of value pricing because the more they can get for selling your house, you're happy you've got more value, you've got higher sales proceeds, and they're happy because they charge a higher price. It's a win-win. If you're selling a business, the corporate finance industry often uses percentage pricing. So percentage pricing, there's no fixed price up front because we don't know until the end result, but it's value pricing. Contingent pricing is a form of value pricing. In other words, and lawyers have this sometimes with a no-win, no-fee. Contingent pricing means the price depends on a particular outcome. If we get a good outcome, there's a price. If we don't get an outcome for the client, if there's no value, we don't charge them. So contingent pricing is a form of value pricing. Another interesting one is retrospective pricing, where the client chooses the price afterwards. And a variation on that is, you may have heard of this, some very upmarket restaurants don't have a menu. You eat the meal, and then as a customer, you choose what to pay afterwards. And because those sorts of restaurants, there's some in London, for example, reportedly they get higher prices because they attract a certain type of clientele, and they have great food, and people having great food will sometimes pay more than what it might have been on the menu. That's a form of value pricing. The customer gets to choose. Coming closer to home to our industry, sometimes accountants ask me the question, what about, instead of a fee, I have equity participation? I'm going to do some advisory work for a client, some consulting work, and rather than a fee, I'm going to take 25% of the shares. Think of Dragon's Den or Shark Tank, where they would take some equity. Equity participation is a form of value pricing. The more value you create, the more you help them build their business, then the more you earn in the form of the benefits of the equity, the valuation, the value and the dividends and so on. And then, of course, the best way to price in our profession, we're very fortunate that despite the complexities of scope, we are in a profession where we have a price conversation face-to-face with the client. We can price every client differently based on their scope, but also their preferences, their choices, and their value. In other words, we create bespoke prices. Every client should get their own unique price. And so because we have conversations with clients, we can then start to use techniques to start to uncover through the right questions, we can uncover what it is that they value. We can then present them with choices and options so they get to pick the things that they value. So we have this great opportunity to employ value pricing because of the fact that we have these conversations with clients. Okay, so that's just to quickly summarize then, we have, when it's looking at what should we use, hourly versus fixed fees versus value pricing. Let's remember though that value pricing is one of two. It's either value pricing or cost plus pricing. Two ways to price. One focused on the supply side, one on the demand side. Value pricing is one of two ways to price. Hourly rates is just a model. It's a pricing model, like contingent pricing, like percentage pricing. Hourly rates, hourly billing is a form of cost plus pricing. We should never use hourly unless we have to for some reason or the client chooses. Fixed pricing is okay in some circumstances where you are perhaps, if you're learning value pricing. Value pricing is not easy. So one of the things I teach is something called the pricing journey. We need to get away from hourly fast because that's killing our profits. Clients hate it. We have to shift away from hourly. It would be crazy for me to try and teach you to move from hourly billing to value pricing. It's too big a jump. It's too difficult. It's too complicated. Very often people struggle with that. So let's take things one step at a time. When I teach the pricing journey, what I recommend you do is, if you're hourly, just move to fixed pricing. Just move to fixed pricing. I know it's still a form of cost plus pricing, but the thing about fixed pricing is you have to figure out scope of work to give a fixed price. You have to estimate the costs. And whilst it's cost plus pricing, that's the hardest bit of value pricing for our profession. We want to make sure that we price based on value, but we want to cover our costs. So we can use fixed pricing to create a baseline, a starting point. So if you're struggling with value pricing, get a system, get a process for confidently giving a fixed price up front. So you can then get rid of the timesheets and stop hourly. Because once you've made that shift from hourly to a fixed price, which is a hard step, moving to value pricing is then relatively easy. Because we can start adding on layers, we can start to introduce different techniques. So if we've got a way of giving a fixed, if we've now gone to, let's say, a tax return, $500 for a tax return, what we can now do is introduce menu pricing. We can actually come up with a bronze, silver, gold option. Let the client choose. That's a relatively easy step up from fixed pricing. We're now starting to get towards menu pricing. Once you've got to menu pricing and you're giving three choices, we can start to then build in some more complexity, some more ideas in terms of how do we uncover value, how do we create those packages to reflect value, what other options can we use the upsell, how do we communicate better the value, how can we use price psychology, and gradually move towards value pricing. But the hardest step is to move from hourly to fixed. So if you're using fixed, great, I congratulate you. If you're giving fixed pricing, that's a great start, but it's still cost plus. What you now need to do is start to then take some steps to move towards value. Okay, hope that makes some sense. Okay, hope you like the music. that's the formal finish of the presentation. So we've got a whole bunch of questions now. I'm going to come on to questions in about 2 or 3 minutes. Just a few things before then that I need to tell you about. So firstly, you may well know that one of the things that we are doing this year is we're trying to do our bit to make the world a better place. We're part of the B1G organisation. I've been friends of Paul Dunn for many, many years. He's an inspiration to me. And what we do now this year is every time that we do a live session, when you show up, we make a contribution on your behalf. So we picked a project earlier today that in Honduras, cooking is done over inefficient open fires inside the home. That creates problems for, with breathing in toxic smoke for many of the women and the children suffer as a result of that. So there's a lovely project where we can help them support those families with clean cooked stoves to help promote better health for the women, the children. And so what we're doing on your behalf as a thank you for coming, after this session, we'll add up the numbers and we will then make a contribution to this particular project. And every time that you come along to one of our live webinars this year, we will be contributing to a project on your behalf. So it's our bit to help make the world a better place. Right, let's just mention about very quickly a couple of other events. So I don't know if you've registered or not. Tomorrow, same time tomorrow as this one, we have a session with David Pankovic, who's from Canada. He's one of my Value Pricing Academy students, doing some extraordinary stuff. And he's going to do a session tomorrow where he's going to be talking about how he's built his marketing system, how he gets prospects, how he prices, and then how he onboards them. It's going to be a really practical session. If you've not yet registered for that, Sarah will put some links in various places so you can access that. And the other thing that you will probably want to know is next month's training. Next month's training, in this format, is Wednesday, April 14. Wednesday, April the 14th. I think that's right, Sarah. Wednesday, so put that in your calendar now. Make a note of that. The topic of that is, what did you say earlier? The one you voted for was 5 ways to use Facebook to win more clients. So marketing topic next month. That's Wednesday, April 14th. We've got many other live sessions coming up. One of the things I do is I go live on Friday now as well, teaching how to use the effective pricing software and answering your questions. So if you want to learn more about effective pricing and how to use that as a tool for getting better prices, I'm doing a session same time as this. It's 60 minutes on Friday. So tomorrow, David Pankovic. Friday, a Q&A with me about pricing software. And then next week is my sessions for the Value Pricing Academy and the Bookkeepers Pricing Academy. Okay, I don't think there's any more announcements, Sarah, so I think we're on to questions right now. So I'm going to open up and put up the Q&A box. And we have 9 questions. Good, I should be able to get through those okay. I'll also keep looking at what's coming on the Facebook group as well. It will help if you do click the link in the Facebook group if you've got it, so I know who you are. It'll jump out at me there and I won't miss your question. So let's start first though. The first one came in was Martina said, often it's difficult for clients to understand what they want, hence this can present a challenge to value pricing. How to overcome this? Martina, great question. Absolutely. Clients don't know what they want. They think they know what they want, but usually wrong. So the example I often give is, client comes in for a meeting with you because they say, I want a cash flow forecast. Can you do me a cash flow forecast? And the absolute worst thing that we could do is say, yes, we'll do your cash flow forecast. Here's the fee, $500. That's crazy because no client ever wants a cash flow forecast. There's no value in a cash flow forecast. No value in a cash flow forecast. The value is in what it does for them. What's the result they want? And so what we have to do is ask questions. It's really about asking the right questions to uncover what is the real reason. Why do they want that? What are the challenges? What's the problems they're facing right now? What's the goals? What's the outcome they want? We have to ask better questions. We are not very good as a profession at answering questions. It's a skill that we need to master. We have to uncover. And I teach, and I've done sessions before on this, I'll do sessions again on the 3 stages of the value conversation. Stage 1 is uncover the value. We have to ask the right questions, and there's a process for doing that we want to follow. Once we've done that and understood value, then we can move on to building the value and then capturing the value in our price. So I hope that helps, Martina. It's all about asking better questions. Kenneth says, but how do you quote a flat fee for a project and still maintain good realization? Okay, so you're on flat fees. Well, flat fees, if you remember, is a form of cost plus pricing. So flat fees means that you are giving a price based on your best guess at hours, at time, and scope. And so as long as you are, and this is one of the challenges, and again, a challenge, but we need to figure out how to better analyze scope so that we can give a fixed price up front. As we get better at figuring out what scope is and how to build that into our price, then we can make sure that we give a price that will always give us a good realization or a good profit. So, so Kenneth, your question's one really about discovering how to uncover scope of the work. And if you want some more help on that, if you go to my YouTube channel and type in scope, I did a video about a year ago on how to, I forget the exact title, in fact, I forget the title. It was something like how to properly scope out a piece of work. So check that out, Kenneth. Erin says, how do you approach asking for a deposit? I've had clients fight not paying it. Do you deduct the deposit off the next bill? Erin, as a profession, we're in the service industry. We should always get paid in advance. Certainly not after delivery. Because if you think about it, everybody else in the service industry, that's the way it's done. You take your car to the garage to be serviced. And when it's done, they'll call you and say, your car's ready, come and pick it up. When you go to pick it up, they don't give you the car and the car keys until you've paid the check. Okay, you have to pay before you can drive away. If you go to the dentist for a checkup, when you've finished, you go back down to reception and they then will say, let's book in 6 months' time. Oh, and by the way, we need the check. They don't say, we'll send you a bill sometime, just pay it when you're ready. And very often in the service industry, you even pay in advance, and sometimes monthly in advance with recurring subscriptions and so on. So it's normal, it's acceptable, we should ask for money up front. If a client objects, Erin, you've said you've had clients fighting not to pay it, then they're not the client you want, because somebody who can't afford to pay you now won't be able to afford you in 30 days when you finish the work. Okay, and so why do the work and then spend time chasing money that sometimes you might never get? Okay, getting money up front, having a deposit is a great pre-qualifier. Michelle says, I no longer charge hourly rates. However, we charge here in the US flat fee for monthly compliance work if we are not estimating within our own firm. How long it will take to do the work to arrive at that flat fee? How do you arrive at the value pricing? Okay, that's a long question. I think I partly covered that, a little while. I may have answered that, Michelle. It's about uncovering the value. It's about understanding what's important to the client, the questions that you need to ask to find what it is they really want from you. Yes, they want compliance work. They come to you and say, yes, I want you to do the bookkeeping work. Great, but why? Why the bookkeeping work? What's the problem that they're having right now that's mean they're coming to you to do the bookkeeping work? And it might be that they're a small business. They've been doing the bookkeeping themselves for the last 3 years. They started 3 years ago. They've been doing it themselves, and they found as the business has grown, they're spending all their weekends doing the bookkeeping, and they're missing their children grow up. Wow. If you take over the bookkeeping, what's the value there? You're letting them watch their children grow up. That's huge value. It might be they tell you that we're just doing this bookkeeping work and I should be going out there winning new business. So the question I would then ask is, okay, so if you had an extra 3 hours every week to win new business, how much new business do you think you could win? And get the client to quantify it. And if the client says, I reckon I could win another grand of work every single week if I had the time. Okay, that's over 52 weeks. That's 52 grand that's being lost because they're doing the bookkeeping themselves. So we ask better questions. We start to quantify, to put a value on us solving their problems. We need to drill down and uncover the problem. And then what we can do is when we understand better through better questions, we then create better choices, better options. It could be that you have a bookkeeping service and a bookkeeping plus. And the bookkeeping plus has some other things built in that's solving some of their problems that they mentioned earlier. And therefore, when they see value in that, they will then choose to pay you a higher price. We let the client choose through various choices and options. Hope that helps, Michelle. Ian Gardner says, we have 11 minutes left. Ian says, I'll do Ian and then I'll look at Facebook for a second. Ian says, since when are you allowed by your professional body to hold shares in a client's business? I can't answer that, Ian, because there's people here from all around the world. And I don't know where you're from in the UK, which professional institute you're with, and so on. You'll need to check out your own particular rules as to what you can and can't do. My understanding is, and bear in mind, I sold my accounting firm in 2006, but the only reason you couldn't hold shares was if you did audit work. And in the UK, audit thresholds are so high now for most clients, you don't do audit work. But you'll need to check. It may not be. And by the way, I mentioned equity participation to give you an example that there are so many pricing models. In fact, in my price consulting program, I teach over 40 different pricing models. Equity participation is a pricing model. I didn't say to you that's a good idea, and I think it's actually a bad idea in many cases. Okay, it can go horribly wrong. You have to be really careful with equity participation. Okay, Lisa, I'll come to you next. I have a question from someone on Facebook right now. I don't know who you are. It just says Facebook user. Says, my menu pricing steps up based on number of transactions. Is this still value pricing? Not really. So I guess what you're saying by that is you're creating, let's say you've got a bronze, silver, gold, and that bronze, silver, gold is differentiated based on the number of transactions. So I guess what you're saying is small business pays this, middle option is for a medium-sized business, top option is for a more expensive, a larger business. That's more sticking with the cost plus pricing, because what you're saying is that your most expensive option is because they've got more transactions, more scope of work. It's very much in the cost plus mentality. So what I would recommend is that what you instead want to do with your packages, you want to, with your options in menu pricing, you want to be differentiating them based on what's important to the client. And what's important to the client, not differentiated by scope of work. You differentiate by scope of work in different ways. In other words, when you come up with an offer to the client, here's the 3 choices of bookkeeping, my bronze, silver, gold. Bronze is the basics, the bare essentials, no frills. Silver, we offer we do some extra meetings in there to support you and to give you advice. And in the gold one, we give you advice to help you build a more successful business. And what you do is, in terms of number of transactions, you use that that's a scope question. You use that to help you come up with the price in the first place. So your bronze, silver, gold, the price of those is partly based on transactions. So every client, because every client has a different number of transactions, every client will get a different price for each of their bronze, silver, and gold. Everybody gets a different price. Okay, I hope that makes sense. If not, I can come back to that. We have 7 more minutes. Questions are coming in fast and I'm answering them. Lisa DeHaas says, I'm on fixed pricing in my journey. Congratulations. One of my customers is expanding and opening another company. Brand new, no scope known. How can I possibly price that one? Okay, great question. If you have no idea what the scope of the work is, that doesn't mean you just go back to hourly billing because customers hate it. It's a crazy way to price. If there's uncertainty, the greater the uncertainty on either scope or outcome, either one or the other, if you don't know the scope, you break it down to milestones, you break it down to phases. And so what I would do, if they're a brand new company, what you could do there is a couple of thoughts. One is you give them a price based on their expectation in terms of the amount of work they'll do and so on, but you make it clear it's a price for the first 3 months. And then it could be 2 months, whatever, I'm going to use 3 as an example. The price is for 3 months. Then you'll meet after 3 months, see how the business is going. You'll then review what you're doing. Is the client happy? And give them some other choices. They might decide they want some help in some other areas. So this is a meeting that gives you the opportunity to sell more stuff. And you say to the client, one of the reasons we meet after 3 months is because we don't know how much work's involved. And so we're going to give you a fixed price right now based on our conversation, how much work you think you need doing. At the end of 3 months, if it turns out there's less work required, we'll reduce the price. If there's more work required, we'll increase the price. Does that seem fair to you? Of course it seems fair, because as long as we are fair, that if there's less work, we reduce the price, but most often it'll be the other way around, okay? So that's what you could do. The other thing that you could do, Lisa, and you're in the Value Pricing Academy, aren't you, I believe? Or is it the Bookkeeper Pricing Academy? One of the things we do in the Value Pricing Academy and coming up later in the year is I teach a service on how to price business startups. I have a full brochure, a full system around that coming up in the next few months. And so essentially the bottom line is one of the things you could do is create a specific service for business startups, because it's not just about doing the compliance work. Business startups have their own particular set of challenges. They have more questions. They need help and support. And so you could build a business startup service which could be highly profitable. And then that covers you just in case there's a bit more work involved on the compliance side. Hope that helped, Lisa. We have 5 minutes left. Is there anyone I've missed so far? So a Facebook one that I just noticed from earlier. What's the best practice on bookkeeping cleanups where you sometimes have no idea what you're getting into? So I think I've partly answered that one. When there's uncertainty, you break it down into milestones. And so and in the case of cleanup work, a minimum of 2 could be more milestones. The first milestone should always be a diagnostic. You do a diagnostic where you go and do some initial work to start to understand the scope of the work. And you charge a fee for that, and that's really important. And then once you've done the work, you've built up some knowledge, you now have a better idea of what's going wrong, and so you can now do a price for the full cleanup. And even if that's uncertain, you can break that down to more milestones. It's a price for doing the next stage. So we just break it down to milestones. Okay, I think there's, I think that might be all the questions in the Facebook group for the moment. Let me move on to, okay, I'm going to answer this one because it came in earlier, so I apologise to I might not get onto your questions, but Vijay Shah said, Mark, I sent you an email with a question, and so I am going to answer that one because I think I've actually, what I've done, Vijay, is, if I remember right, just bear with me a second, I think yes, so Vijay, you sent me this earlier, and it's a great question because it fits in with today. So Vijay says, and I hope you're well, by the way, I've never been able to understand value pricing, so hopefully I've helped with that. To me, it seems to be ability to negotiate the best price for our work, and hence needing negotiating skills and judge clients' needs and urgency. Yes, more the latter than the negotiation. It's about judging clients' needs and a sense of urgency. The more urgent, the more value there is in fixing it. So you go on to say, it somehow seems wrong to take advantage of a client's situation and ignorance. We've always worked as professionals who were experts and always knew more than the client's need. And so, and it's a great point that essentially the reason why we want to move to value pricing is because we're charging too low right now. We want to put our prices up. And so value pricing is an opportunity to put our prices up. And we must do that because it's fairer on the customer, Vijay. It might sound strange, but it's fair on the customer. Now, when you put your prices up, firstly, clients are not stupid. Okay, you might think of a few that are, but generally speaking, clients aren't stupid. They know the value they're getting from you. Sometimes they even know they're getting a great deal. And when you go with a high price and they say yes to that, it's not you ripping them off because they know that they value you. Just like, for example, it's over there now, but I've just bought an iPhone 12 in Portugal, where I am right now. It was €1,400. Now, I know I could buy a phone from someone like Motorola for about $50. Okay, about 20 times the price I paid. Is it because I'm stupid? You might say yes, but it's because I know I can buy cheaper. I know I can buy cheap phones, but I see value in the iPhone. I love photography. I would willingly pay $1,000 for a good quality camera. And the fact that my iPhone 12 does a million other things as well is just a bonus to me. So customers, you will have customers that are happy to pay higher prices because when they pay higher prices, they know they are getting more. And let me give you an example, and I think you're in the UK. Not that it's a UK exclusive, but one of the things we do in our profession is we might see a client who's a sole trader who could benefit from moving their business to a limited company. We call it incorporation. I'm going to be teaching this in the Value Pricing Academy next week, I think, on Thursday. What happens, and I've done benchmarking studies around this, most accountants in the UK, for setting a client up as a corporate entity, charge £200, £300, £400. That's crazy, and I did myself back in 1996. And yet, I would argue that if you charge £200 or £300 for doing an incorporation, you are being negligent. Not on purpose, but when you think about it, we're not just buying a company off the shelf, we're transferring a trade from a sole trader business or a partnership into a corporate entity. And when we start to understand that better, we realize there are dozens of things we have to think about. So I'm going to give you the UK examples, but for example, VAT, sales tax, transfer of a going concern, that's going to be thought about. How do you transfer employment contracts? In the UK, I think we call it TUPE, T-U-P-E. How do you transfer the assets? There are, I teach this, and there's a list of about 20 things we have to consider. Things that, pitfalls, tax planning opportunities. You cannot do all those things when you're charging £200 or £300. You can't do them. You owe it to the client to charge a premium price so that you can do the best possible service you can. We can't cut corners. We're doing a disservice when we are cheap. So we have to just recognize, Vijay, that we're in our profession, we can change people's lives. We have so much knowledge. We have these qualifications, this experience. We're doing our CPD points all the time. We can change people's lives through whether it's tax planning, advisory, whatever. And we should make sure that every client gets the very best level of service. But we can't afford to do that if we're too cheap in the first place. We owe it to our clients to be much more expensive so that we create the space in our lives, the budget, the time to go above and beyond and do something even more extraordinary than ever before. I hope that helps with that. We have gone over by 1 minute. And I appreciate, and there are 11 more questions. So I apologize if I haven't answered your question. Here's how you can get your questions answered. Number 1, go into my Facebook group, Value Price with Mark Wickersham. You can ask questions there. There's over 8,000 people in there. You'll get answers from not just me, but everybody else in the community. So if I've not answered the question, go into the Facebook group and answer that question. If the question's about my effective pricing software, come on Friday, and I will answer on the Friday session. Or the third opportunity is come along to next month's session. And I tend to go through the questions in order. So the earlier you get your question in, the more likely I will answer it. And if you're in the Value Pricing Academy or the Bookkeepers Pricing Academy, we have all of our sessions next week. And I will definitely answer your questions, because those we go on a bit longer if necessary to answer your questions. Right, thank you so much for coming along. I will see you all. Perhaps tomorrow's session will be a great session. I might see you tomorrow, if not Friday, if not next week. Goodbye for now.